pat on the back. In its first review of the reform program it is supporting with a loan of $5.2 billion, the International Monetary Fund, IMF, raised its growth forecast for the Egyptian economy during the current financial year to 2.8% compared to the 2% it expected last June. It also cited milder than expected contraction during the coronavirus pandemic. The IMF's executive board's completion and approval of this first review enables Egypt to draw a second tranche of the standby loan agreed on in June to contain the economic fallout of COVID-19. Strong consumption, according to the review, has helped offset weak tourism and investment, while the resumption of portfolio inflows has eased financing pressures, improving foreign currency supplies on the local market. With a high population growth rate, household consumption feeds growth. Historically, around 80% of GDP is derived from household consumption. Portfolio inflows result from foreign investors being drawn to Egyptian pound-denominated treasuries since the 2016 devaluation of the pound due to their high yields, stable currency, and signs from the government that it is committed to further economic reforms. The returns offered by Egypt's local currency bonds remain some of the highest among emerging markets. Overall flows by the first week of December reached $23 billion, after plunging to $10.4 billion in May amid emerging market sell-offs by foreign investors. Assessing different indicators, the review pointed out that net foreign reserves and primary balance outperformed their targets. Foreign reserves reached $40 billion in December, the highest figure since April. Foreign reserves came under serious pressure amid the sell-off in emerging markets due to COVID-19, with $10 billion lost between March and May. According to the IMF, tax revenues soared by 14% year-on-year in the third quarter of 2020, due to strong growth in corporate income tax receipts offsetting weaker VAT collection. According to the review, Egypt also managed to meet all the IMF targets set for health and social spending, the government's overdraft at the CBE, Central Bank of Egypt, and the share of short-term net domestic issuances. The $100 billion emergency response package that the government allocated to dealing with the pandemic was channeled into providing financial relief for the most affected sectors and individuals, bringing 124,000 vulnerable households into social safety nets. It set up a $3 billion fund to support irregular labor, including one-off disbursements of $500 and higher payments to women community leaders. The CBE's monetary policy has helped anchor inflation expectations and achieve low and stable inflation. With inflation rates being contained to hover around a 4% average through 2020, IMF staff have supported the CBE's decision to lower interest rates in September and November to support economic recovery. IMF staff welcome the focus on green recovery and Egypt's leading regional role in this regard. In September, Egypt was the region's first ever issuer of green bonds, with an offering of $750 million in issuance of green bonds to be used in environment-friendly projects. However, the review underlined some challenges. The still high level of public debt and gross financing needs also leave Egypt vulnerable to a reversal of capital flows, which risk triggering again financing and exchange rate pressures, the IMF said. Egypt's total debt, both domestic and foreign, is projected to stabilize at 114% of GDP in the fiscal year 2020 to 21, hitting $7.2 trillion compared to 115% of GDP in 2019 to 20. Prior to the COVID-19 crisis, the authorities had made significant progress in reducing public debt from nearly 104% of GDP in 2016 to 17 to 85% in 2018 to 19. The plan focused on reducing the cost of borrowing by diversifying its sources and making the maturities of domestic debt longer. Sustained progress in shifting towards longer-term debt issuance will also help reduce gross financing needs and improve the risk profile of public debt by lowering rollover risks, the review noted. The Ministry of Finance has been working with the CBE to extend the tenors of Egypt's treasury bonds, rather than relying on instruments with 3- and 9-month tenors. By the end of June this year, average maturities were 3.2 years, up from 1.3 years in June 2013. In addition, the IMF recommended that fuel price adjustments should continue to be in accordance with the indexation mechanism introduced in 2019 to ensure that retail prices will adjust to changes in the exchange rate and oil prices in order to support the budget. A version of this article appears in print in the January 14, 2021 edition of Al Ahram Weekly.